Your picks this week are undervalued stocks that have a combination of growth and value characteristics. They're sort of a blend. Now, your first pick this week is Intercontinental Exchange, so tell us about it.
So it's a 5-star rated stock, trades at a 22% discount to fair value, has a 1.5% dividend yield. It's a company we rate with a low uncertainty and a wide economic moat. That wide economic moat being based on cost advantages, network effect, and intangible assets. And I'd note too that this, if you look at the Morningstar, the 9-box style box, this stock falls in that mid-cap core category.
Now, stock's down more than 10% this year. So what's been going on with it and why do you like it?
So I'd say a big portion of the reason for the sell-off in this company is it's just been lumped in with all of these other companies where people are concerned that artificial intelligence may disrupt their business, in some way, shape, or form going forward. In our view, our investment thesis here really is unchanged, even when we can conceptualize how AI, may or may not impact, trading going forward. Overall, the company is the dominant futures exchange globally, especially in energy contracts. When we think about the economic moat here, we think that their liquidity-based network effects are nearly impossible for AI to try and replicate or disrupt. Again, for trading, you really need to have, the clearing and the collateralization requirements. We think that creates a barrier to entry from artificial intelligence. And then lastly, the company has a huge amount of proprietary pricing and market data. In a world of artificial intelligence, when everybody is going to be basing all of their AI searches on public data, we think that proprietary data is actually even worth increasingly more over time. And then lastly, it's just the New York Stock Exchange. And when you think about the New York Stock Exchange and the specific proprietary data that has, we still think that this company has those long-term durable competitive advantages that you're able to buy at a pretty attractive discount in today's market.
Now, your second pick this week is a REIT, American Tower. Give us the highlights.
4-star rated stock, 24% discount, attractive dividend yield at 4.1%. We rate the company with a medium uncertainty and a narrow economic moat, that narrow moat being based on efficient scale and switching costs. And similar story, if you look at the Morningstar style box, this one falls into that mid-cap core category.
Now, REITs have done, reasonably well this year, but American Tower has been kind of flat. So why is this one attractive?
When I take a look at the entire category of real estate investment trusts, all the cell phone towers have been selling off. And to some degree, I think a large portion of that is just because people are concerned about how SpaceX may disrupt or displace kind of that traditional wireless business, over time. I've talked to Mike Hodel about that, and he just doesn't foresee that anytime soon. When he thinks about the cell coverage that SpaceX can provide today and where it's going, he thinks it's more of an overlay than it is necessarily a replacement for traditional wireless. So in this case, they can use it in those rural areas that you don't have cell phone towers, but in urban or suburban areas, you're still much better off. The economic value still really provides a big advantage for those cell phone towers where there's enough density that you can really get a lot of fixed cost leverage off of those towers that you don't get from satellite coverage.
Your third pick this week is a name we've touched on earlier in the program. It's Northrop Grumman. So run through the key metrics on this one.
Stock's trading at almost a 20% discount to fair value. It's enough to put it in 4-star territory. Somewhat attractive dividend yield at 1.8%. We rate the company with a medium uncertainty and a wide economic moat, the wide moat being based on switching costs and intangible assets. And once again, if you look at where it's placed in that Morningstar style box, it falls once again into that mid-cap core category.
So why do you like the stock now?
So when I think about the trading pattern for this stock, this was a prior pick in 2025. It traded up pretty substantially since then. In fact, it went into 2-star territory in March, which of course, anytime something hits 2 stars is usually a pretty good indicator to take at least, some of the profit off the table. But the stock sold off too much to the downside. So I think this is giving you that ability to, if you sold some of that stock or just hadn't gotten involved in it, a good ability to be able to pick some up at a pretty good margin of safety from its fair value. When I look at the earnings report from Q1, Results were just fine. In fact, our analysts noted that the company had reached agreements to accelerate production of the Sentinel ballistic missiles, accelerate the production of the B-1 bombers. So fundamentally, I think everything is still going well here for the defense companies and for Northrop, overall. We think that it bodes well for the company's ability to meet our forecasts. So I still think that there's further upside in this stock.
All right, your next pick this week is Hershey. Give us the bird's eye view on this one.
So Hershey's currently trading at a 25% discount, with that being a low uncertainty stock. That's more than enough to put it in 5-star territory. Attractive dividend yield at 3.4%. We rate the company with a wide economic moat based on cost advantages and its intangible assets. And if you look at the Morningstar style box, once again, this one falls into that mid-cap core category.
Of course, rising cocoa prices and consumer belt tightening have hurt Hershey's. So why do you like the stock?
I think this is another instance where you can kind of double dip on a stock that we've recommended in the past. So it was a pick multiple times in 2025. Generally, the stock had moved up and to the right since we were making those recommendations. But then the stock peaked this year. I think it was like maybe in February or March, running well into that 2-star territory. And in this case, it's sold off and it's overcorrected to the downside. So I think you're getting that opportunity that if you took some profit, you can move back into that equal weight or maybe even an overweight position. As you mentioned, the stock is very correlated to cocoa prices. Cocoa prices had skyrocketed in 2023 and 2024, but then they declined throughout the year in 2025, bottomed out, and now they're starting to creep, back up again. I'd say at this point, they're still pretty far below where they peaked out in 2024. So we don't necessarily see this as something that's going to disrupt their gross margins all that much here, in the short term. Depending on the type of chocolate, and the amount of cocoa that you use, it's typically only like 20 to 50% of cost of goods sold. So a little bit of margin pressure, but not enough really to change that longer term investment thesis. I just note, Hershey has dealt with high prices in cocoa before. They're going to have to deal with high prices in cocoa at points in time in the future, but it's one of those things that really impacts every chocolate manufacturer out there. So it's not, endemic just to Hershey. When you think about the company overall, 36% market share in the US chocolate market. That compares to, 29% at its closest competitor, which is Mars. But really, the rest of the market, the remaining, branded and private label competitors all have very low market shares out there. So that's part of the reason that we look at this company as having long-term durable competitive advantages. And it's not necessarily expensive, trades at 20 times our 2026 earnings estimate, drops down to 18 times our 2027 earnings estimate.
All right, your last pick this week is Amazon. Give us the key points on this one.
So it's trading at a 12% discount. It's enough to put it in 4-star territory. Not a dividend stock, so if you're a dividend investor, it may not necessarily be right for you. We rate the company with a medium uncertainty and a wide economic moat. And in this case, I would note that it's only one of 2 companies out there that have 4 of the 5 moat sources. So in this case, cost advantage, switching costs, network effects, and intangible assets. And if you look at the Morningstar style box, this one falls into that large cap core category.
So Dave, a double-digit discount's pretty good. So I'm not going to say it's not a bargain, but, talk a little bit about why specifically it's your final pick this week.
So it kind of also goes back to when you and I talk about core stocks. So in this case, I differentiate between a core stock for your portfolio versus how a company may fall into that core category in the Morningstar style box. So the Morningstar style box is broken out between value, core, and growth. So a core stock in the style box is one that has some attributes of growth stocks, some attributes of value stocks, but not necessarily enough that it falls into one of those 2 categories. And so it kind of ends up in that core category. Now, when you and I have talked about core stocks and think about like your portfolio, those core stocks are the ones that have attributes of a long-term hold position. The kind of stock that you want to own through economic cycles, the kind of stock you want to own through different market cycles. It's the stock that really forms the basis of your portfolio that you can then build other positions around. They're companies that have a very long runway for growth, companies that have long-term durable competitive advantages, companies with strong balance sheets. And in this case with Amazon, the company still still continuing to hit on all cylinders. I think there's still a long runway, still very much upside from AWS. That's its AI platform. Margins here can continue to keep improving, in the retail business. We think the advertising business is very valuable. So overall, we're still looking for just very kind of stable growth, both on the top line, looking for that continued margin expansion over time. So in my mind, I still think Amazon is kind of one of those core stocks for your portfolio, as well as it's a core stock in the Morningstar style box. Taking a look at, our model here, the company, we're averaging, 15% earnings growth over the next, 5 years. And you're getting it at a bit of a discount to its historical multiples where it's trading today. So it's trading at 30 times our 2026 earnings estimate. But if you look at kind of the historical average of where it's traded over the past 5 years, it used to trade much closer to 40 times. And over the past 10 years, it was trading at 57 times. So that 30 times multiple may look expensive, but when you start thinking about the type of average earnings growth that we're looking for and how it's traded in the past, looks attractive to us here today.